Hello everyone and welcome back to another video. In today's video, we're going to be talking about Berkshire Hathaway and a bunch of other legendary investors buying United Health stock and United Health rallying 12% on the day. A brand new stock that I am actively researching and I think looks very interesting, and the software stock Armageddon and sell-off that has been going on in the market. These are the really hot topics in the market right now, and many of them impact my portfolio personally. So with that being said, let's dive into it and get started with Berkshire Hathaway buying United Health. My social media is absolutely blowing up. This is pretty much all that I have been able to see today is the announcement that Berkshire and Warren Buffett have been buying United Health stock. But what's interesting is this is actually a pretty small position in the Berkshire Hathaway portfolio, which is only 0.6% of their total portfolio allocation. So I am not entirely sure or confident that Warren Buffett himself is buying United Health stock. It could be someone else who manages the portfolio because, again, this is a pretty small position. Now, what's also interesting is this filing from Berkshire Hathaway came out for the second quarter of 2025. And we can see here on UNH's chart that the end of the second quarter, the stock was trading for around $312 per share. Then after the second quarter, the stock continued to fall another roughly 24% all the way down to $238. So there is a chance that Berkshire continued to average down on this position and buy even more after the second quarter ended. And a lot of people online are speculating that this was just a starter position and that Buffett and the team are continuing to buy the stock down. Obviously, that is just a guess. No one has any freaking clue what they're actually doing. But I could see them continuing to average down as the stock did fall another 20% after they announced that they took a position. What's also interesting and fueling this rally even further today is that other legendary investors like David Tepper and Michael Burry have taken on UNH in their portfolios and pretty large allocations. So it seems like super investors are buying the dip on UNH stock, and this is kind of causing more people to buy into the stock, because this is like confirmation, I guess, that UNH may be looking cheap here if so many super investors are buying into the stock. Now, I did make a full dedicated video on UNH and what was going on with the stock, why it is down so much on my channel. So I'm not going to rehash why the stock is down and really my opinions on it. So if you want to see my full in-depth analysis of UNH, then I would recommend watching the video that I have previously made. But I do want to update you guys with some of my opinions here. So right away, UNH is projecting earnings per share of roughly $16 for 2025. The stock is trading for $304 today. So if we divide that by 16, then we can see that it is trading for around a 19 price to earnings ratio based on the earnings they expect to produce this year. At face value, this is not a crazy high price to earnings ratio to pay for a business, especially one of the largest companies in the world. Now, if we also take a look at United Health's long-term revenue, we can see that it is a very consistent growth chart. And even as of the most recent quarter, United Health is producing a record amount of revenue, and the business seems to be growing the top line just fine. So the fears around this business maybe being disrupted by the Trump administration so far seem like they are unfounded. But what is the concern is the company's earnings potential and the cost pressures that are building up for this business. And if we take a look here, we can see that United Health's earnings are not at an all-time high, and they are down to about $21 billion now from their all-time high of $22 billion. And United Health is actually expecting their earnings to continue declining for the remainder of 2025. They're expecting a little bit more of margin compression for the remainder of this year. The new CEO, who was actually the former CEO, has returned, and he wants to get the cost pressures under control and improve the margins going forward. He was the CEO of United Health Group for a very long period, so I do actually think that it is bullish that he's back because he does have a long track record of running this business efficiently and producing a lot of shareholder value when he was at the business previously. So again, I do think that it is bullish that he's back, and I do think that, this is one of the largest companies in the world, and it isn't unlike Warren Buffett to get interested in some of the largest, most profitable businesses in the world when they are going through periods of uncertainty. What he does is he likes to buy into unusual situations when these large companies are going through some controversy, but he also has to have conviction that it's a situation that can be turned around. So since Berkshire Hathaway is purchasing United Health stock, then I do think there is a pretty strong argument that at least someone at Berkshire thinks that the situation that United Health is going through is fixable and that the business will be fine long term. So now let's go and take a look at United Health's PE ratio today versus its long-term averages. And here we can see that United's long-term average PE ratio is around 21. And right now, based on its trailing 12 months earnings figure, it is trading for about 13 times earnings. But as we saw, the company is projecting about $16 in EPS for this year, which does put it around a 19 price to earnings ratio. Now, if we just value it off of that basis alone, then the company is not actually looking that cheap, which means that for the company to be looking cheap today, investors are expecting the margins of United Health Group to expand once again in the future and for its profitability and efficiency to increase going forwards. Because if the company can only maintain that $16 in earnings per share, then honestly, the stock does not look very cheap today, especially relative to its long-term averages. So again, I do think that investors are expecting some margin expansion going forward from here, and for the earnings to grow in line with the revenue once again. Now, I have also been asked a lot if I am going to be buying United Health Group stock or not. And to put it simply, I'm not really interested in buying this one. United Health is way out of my circle of competence. When I did do my dedicated video to this stock and analyzing it and looking at the opportunity here, objectively, I do think that there is a pretty compelling argument that this stock does look very cheap right now, especially if they can right the ship and get the earnings growing and get through this period where their margins are being compressed. But I don't like to buy stocks just because they're looking cheap on the financials. I do have to feel a strong conviction that I understand the business, I understand its moat, and I feel like I really just understand the company at a very deep level. And when it comes to United Health Group, when I was analyzing this business, looking through all of the controversies that they're going through, trying to understand their different business segments, I was like, this would take me forever to deeply understand what's going on here. And when I get into that situation, I just put things in my too hard pile. Like, I don't need to own every stock just because it's down, 50% from its all-time highs. And I have consistently said here on my channel that there are certain industries that I simply will not invest in because they are either poor industries that I don't think, the players in the industries have moats as a whole, they don't have good economics, or they're out of my circle of competence. Healthcare is an industry that is out of my circle of competence. Insurance is another industry that is out of my circle of competence. Like, whenever I try to figure out what is going on with an insurance company, I just get very confused. Apparel is another industry. I do not think the economics and predictability and moats in the apparel industry are predictable for someone like myself. Airlines, cannabis, those are other industries that I simply don't invest in because the economics are pretty poor. United Health is a health insurance company. So it's like a double whammy out of my circle of competence. So for me, I'm just not very interested in buying this stock. I do hope that everyone makes a lot of money if you are buying it and you're interested in it, but I just don't feel comfortable. It's not a stock that I would add to my portfolio and feel comfort with. If I were to buy this one, it would literally be because I think that it is looking quite cheap, and that's not something that I want in my portfolio. In fact, I have been burned by those situations before where I think that something looks objectively cheap financially, but I don't quite think it's a high quality business, and then I end up getting burned. So I'm trying to learn my lessons, and I'm not trying to buy stocks just because they look cheap financially anymore. I do want to have a deeper understanding of the business, its moat, and have that conviction. And with United Health, I simply don't. So that's my thoughts on United Health. That's the major news with this one, and that's why the stock is rallying so much today. All right, let's move on to the next segment of the video now, which is going to be discussing a stock that I think is looking quite interesting. This stock is Zeta, or Zeta Global Holdings Corp. Now, this company IPO'd all the way back here in 2021, and it has been very volatile since then, peaking here at around $37 in November of 2024, and the stock is down something like 50% from its all-time highs now. However, the fundamentals of this business have continued to grow, and I do think that the stock could potentially be offering some value here. Now, full disclosure, I have not taken on a position in Zeta yet, but it is a stock that I am actively researching, and I want to show you what I have found so far and why it is looking interesting to me. So with that being said, let's start off by discussing what Zeta's business actually does. Zeta's business is all about helping large companies find, win, and keep customers using a powerful combination of consumer data and artificial intelligence. In simple terms, think of a traditional marketing team that has to use a bunch of different tools. One for email, one for social media ads, one for customer data, and so on. They have to constantly move information between these tools, which is inefficient and often leads to a fragmented view of their customer. Zeta's unique value proposition is that it provides a single, all-in-one platform for marketing. This platform, called the Zeta Marketing Platform, is special because it's built on a massive proprietary database of consumer information, and it uses artificial intelligence to make sense of all of this data and connect it. A key selling point for Zeta is that its data network is built independently of major players like Google and Meta. This gives its clients more control and a way to reach customers outside of those walled gardens, as they call them, which is becoming more important as privacy changes impact traditional advertising. Instead of using separate tools, Zeta provides what it calls its brain that combines everything together. It can see that a person who clicked an email, then browsed a website, then saw a social media ad is all the same individual. This gives a much more complete picture of what a customer is doing and what they are interested in. The platform then uses artificial intelligence to analyze all of this data and predict what a customer is likely to do next. For example, it may identify that a person is likely to be in the market for a new car, and then help the car company target them with a personalized ad across different channels that the consumer uses frequently or is about to use next. Basically, Zeta has a large proprietary consumer database, and it uses artificial intelligence to connect the dots between all of this data. Then my next question was, how is Zeta any different from Meta or Google? Like, why would a customer want to go and advertise with Zeta over using Meta or Google ads? And here's what I found. So in regards to Meta and Google, their advertising platforms rely on their own first-party data. Google data comes from search queries, YouTube videos, and Google Maps usage. Meta's data is generated from what users do on Facebook, Instagram, and WhatsApp. Advertisers are essentially renting access to a massive pre-built audience based on these platforms' specific data. Now, on the other hand, Zeta has built its own proprietary data cloud, often cited as the third largest behind both Meta and Google. Its data is collected from a wide variety of sources, including websites, email lists, and other third-party data partnerships. This makes it an independent data source, allowing brands to reach consumers outside of the Google and Meta ecosystems. This is a crucial distinction as companies seek to diversify their marketing spend and reduce their reliance on the two major tech giants. Meta and Google's platforms use AI and machine learning to optimize ad campaigns for specific goals, like getting more clicks on a specific ad. Their AI is focused on improving performance within their respective ecosystem. Zeta's AI is the brain of the entire platform. It's designed to predict consumer intent and behavior across different channels. For example, Zeta's AI might predict that a customer is likely to churn, and then automatically trigger an email campaign or a special offer to try and retain them. This predictive capability and cross-channel orchestration are a core part of its value proposition and its main differentiator between both Meta and Google. So overall, this company seems very interesting, and it seems like a different type of marketing and advertising spend. It seems more like a predictive artificial intelligence tool that can make customer marketing much more effective by targeting specific customers and specific consumers where they're at and based on what they're most likely to do. And it's much more wide and diverse. It goes across the entire internet. It can send out email campaigns. It can create different things. And it's not specific to just Meta's ecosystem or Google's ecosystem. So it does seem like a very interesting company, and I am going to continue researching it. Now, with that being said, I did go through Zeta's most recent earnings report, and I took screenshots of the highlights that I found. So right here, we can see that Zeta has had 14 straight quarters of over 20% revenue growth. And in the most recent quarter, they experienced 35% year-over-year revenue growth, and the growth rates are currently accelerating, which I think is a great thing to see. Moving on to the next screenshot, this says Zeta launched Zeta Answers, which improves engagement and helps drive a higher return on investment. So Zeta is continuing to launch new products for their customers, and this is helping increase the average revenue per user or the average spend per customer. Then this says continued momentum with the large agencies, resulting in 40% year-over-year brand count growth. So the number of customers that Zeta has is also increasing by roughly 40% year over year, which I think is fantastic to see. Multiple one Zeta wins, resulting in the highest year over year customer growth and the number of customers using 2 or more use cases. So Zeta experienced the highest growth to customers using more than one product. So customers are continuing to use more of their products, and this is helping increase the average spend per customer. Then down here, they say that they are increasing their fiscal year revenue guidance by $21 million to $1.26 billion for the full year, which is up 26% year over year. They also increased their free cash flow guidance by $10.5 million to $142 million at the midpoint, up 54% year over year. So Zeta increased their guidance, and it looks like they are projecting margin expansion for the remainder of the year, as free cash flow is projected to grow much faster than overall revenue. Now, this next screenshot I find very interesting. So this says, the longer our customers stay with us, the bigger they become. And it shows that their customers that are with them for less than 1 year tend to spend $900,000 within their first year. Then customers that had been with Zeta for 1 to 3 years end up spending roughly $1.2 million. Then their customers that had been with them for over 3 years, on average, spend $2.6 million per customer. This is a clear indicator that Zeta is able to upsell their customers and that their customers want to continue spending more money with their platform over time. This suggests that customers see a high return on investment by using Zeta's platform, and they want to dedicate more of their capital and more of their marketing spend to Zeta. And I think that this is a great indicator. And I also believe that when you can increase your average revenue per user, it is a sign that your business has a moat. So I think that this is a great thing to see from the business as well. And I love companies where customers continue to spend more money and allocate more money to them over time. Moving on, their next screenshot says that they are serving 44% of the Fortune 100. They have 2 of the largest airline companies. They have 2 of the largest automotive companies in the world. And if you want to pause the video, you can see the rest of their allocation, but they have some of the largest companies in the world using their platform. Moving on, this next slide shows Zeta's outlook for 2028. And currently they're expecting their 2028 revenue to be $2.1 billion, which is a 20% compounded annual growth rate to revenue over the next 3 years. And then down here, we can see that their 2028 free cash flow projection is $340 million, and they are expecting their free cash flow margin to continue expanding to 16%. So they are expecting their free cash flow to more than double over the next 3 years as the business grows and margins expand. Moving on to the next slide, this one talks about stock-based compensation. So this says, stock-based compensation is declining as both an expense as a percentage of revenue. And we can see that the stock-based compensation as a percentage of revenue for 2025 is expected to come down to 15%. Now, this was my one major hiccup with Zeta, is that historically their stock-based compensation has been straight up, it's been way too high for me to be interested. But what is good to see is the CEO and the management are clearly addressing this issue, and they are actively trying to lower their stock-based compensation at the same time as the business's free cash flow is expanding. So if this trend can continue, then the stock-based compensation should become less and less relevant over time, which would kind of be my thesis if I do end up entering this position. So let's head over to Stock Unlock now and take a look at some of their longer-term KPIs. And here we can see that Zeta has been growing its revenue quarter over quarter consistently for the past 5 years now. This is on a trailing 12 months basis, but we can clearly see that the business is growing rapidly. And what's also interesting is its revenue growth rates are accelerating, because the compounded annual growth rate to the revenue over the past 5 years has been about 29%, but over the most recent year, they have seen their revenue growth rates accelerate to 35%. So as this business has scaled, it has been able to accelerate growth, and I think that is fantastic to see. Now, if we move on to the cash flow statement, we can see that operating cash flow is growing very well. It's at an all-time high of $155 million in the trailing 12 months. So it is very clear that this business's profitability is in fact growing. Now, if we take a look at the stock-based compensation, we can see that it is still pretty high at $178 million in the trailing 12 months, which is actually more than the company generated in operating cash flows. So this stock-based compensation is still way too high in my opinion, but we can clearly see that the trend is coming down and the management does want the stock-based compensation to continue coming down as the business scales. So we're going to have to see how this plays out. And the reason why I do not like so much stock-based compensation is because it dilutes shareholders. And here we can see that Zeta's share count has compounded by 16% since 2022. Now, the company is expecting their annual dilution to be between 2 to 3% going forward from here. So the share count growth rate should decelerate significantly, but it is worth noting that they are expecting some continued dilution to shareholders. So let's now head over to my DCF calculation on Zeta here. So in this DCF, I'm using the free cash flow and I'm projecting it to grow by 40% annually over the next 3 years. And if we scroll down, this would result in about $327 million in free cash flow by the second quarter of 2028. So this is about the growth rate that the company is projecting to its free cash flow is about 40% annually over the next 3 years. I also have Zeta continuing to dilute by about 3% per year, and the company trading for a 25 price to free cash flow, which I think is very fair for a business growing its revenues by over 20% annually, and growing its free cash flows by an even faster rate. So basically, if Zeta can meet their projections of hitting $340 million in free cash flow by 2028, maintaining about 3% annual dilution, and trading for a 25 price to free cash flow, then the fair value of the stock is around $26 per share, and it could compound by about 22% annually over the next 3 years. So basically, if Zeta can hit their projections over the next 3 years, then I do think that the stock is looking very compelling today, and it could offer a market-beating return from here. Another way to think about this company's valuation is they are projecting $340 million in free cash flow by 2028, and the valuation is $3.67 billion today. This means that the price to free cash flow on cost of the business right now, relative to their 2028 projections, is around 10. So in the future, if they can hit those projections, then I think the price today will look pretty dang compelling. My thing about Zeta is I do not understand the business well enough yet. I do not know how easy it is to replicate their data collection systems, and for a new company to simply try and come in, get the same amount of data, and replicate their artificial intelligence. So basically, I don't know for sure about this company's moat yet, but when I take a look at the company's financials, its balance sheet, its cash flow, its accelerating growth, and its price today, it does look very interesting and compelling. So this one is on my watch list. I have not purchased it yet. I do want to learn more about the moat and its durability against potential competition in the future, but right now, this one is right near the top of my research list, and it is an active candidate that I am exploring. So I wanted to share it with you as well and kind of show you the things that piqued my interest and why I think that this one is looking interesting. Moving on to the next topic now. This one is that software companies as a whole have been seeing a lot of weakness in the market recently. These are stocks like Salesforce, Fortinet, CrowdStrike, Palo Alto, ServiceNow, even Constellation Software have been seeing a lot of weakness. And this is largely because of artificial intelligence. A lot of investors have been leaving the software space entirely because artificial intelligence is continuing to get better and better at coding. And the bear case theory here is that 5 years out into the future, artificial intelligence is going to get so good at coding that it's going to be able to replicate what these companies have. It's going to be able to replicate the software that they have built. And at that point, it's either going to be customers are going to be able to in-house build, vibe code their own software, or engineers are going to be able to code this software, replicate it, and sell it for a much cheaper price, which is going to cause an increased amount of churn or margins to compress as competition increases. That's the really big bear case against software companies today. And I have spent some time looking into this because I do own Constellation Software, Topicus, and a few other software companies in my portfolio, and they have been getting hit as well. So I have dedicated time over the past week to looking into this bear case, thinking about it, and seeing what the CEOs of the companies that I own say about artificial intelligence potentially disrupting their businesses. But first, I want to run through some of the top software stocks out there that I have been getting asked about because I've been getting bombarded by a lot of questions. So I want to give you my opinions on some of the top stocks. The first one is CRM or Salesforce. This one is down roughly 34% so far in 2025. It has been getting hit pretty dang hard. And we can see that its price to free cash flow is now sitting at about 17.7, which is a free cash flow yield of 5.7%. And people have been saying that this stock is looking very cheap. So let's go over to Salesforce revenue really quickly and take a look at its long-term revenue growth. The one thing that I'm noticing here is that Salesforce growth has been continuing to decelerate for a very long time. and its growth rates are now at its lowest point in the company's history. And I believe that in the last quarter, the company's revenue grew 7% year over year. So it seems like this business is now really struggling to maintain high growth rates. And personally, I'm not too interested in a business that is seeing decelerated growth and it's now only sitting at 7%. Now, what the bulls have been saying is that Salesforce cash flows have been growing much faster than the revenue. And that is true. Salesforce operating cash flows have been growing significantly over the past about 18 months, and they did hit an all-time high of $13 billion. However, my issue with this is that you cannot have your profits grow at a faster rate than revenue forever, because when this is happening, it means that your profit margins are expanding, and profit margins can only expand so much. So at some point, Salesforce is not going to be able to get that operating leverage, and I think that we are already starting to see this. Its operating cash flow margins have topped out at about 35.5%, and they haven't really expanded in about 3 to 4 quarters now. This ultimately means that Salesforce profits, its cash flows, should grow in line with the revenue now, as they're not able to expand margins anymore. So basically, profit margin expansion like that is kind of like a one-time hit to your profitability, and then it maxes out, and then it gets to a point where you can no longer expand it, and then your profits will grow in line with revenue. That ultimately means that Salesforce cash flows may start to only grow by 7 to 10% annually. And when we're talking about a price to free cash flow of about 18 for 7 to 10% annual growth, I think that might be around fair value, but it's not like the stock is looking like an absolute steal in my opinion. Now, additionally, Salesforce does a lot of stock-based compensation. And when we factor in stock-based compensation, Salesforce is actually trading for about 25 times cash flows. And again, for 7% growth, that's really not that exciting in my opinion. So for me, I'm not too interested in Salesforce. It seems like an okay business selling for maybe a fair price. And yeah, that's not just really what I'm looking for in my portfolio. Now, moving on to CrowdStrike, this is another one that has been seeing weakness lately. It is down roughly 17% from its all-time highs now. It's in a slight correction, and people have been asking me about this one as well. Now, right away, CrowdStrike is way too expensive for me to consider adding to my portfolio at all. Here we can see that its price to sales ratio is at 25 still. Its price to free cash flow is 103, which is just simply way too much for me to be interested in any stock. We can see that CrowdStrike's operating cash flows have grown tremendously over the years. They have topped out in the past few quarters, but overall, I do think that the profitability of this business, its potential is still very high. However, here we can see that CrowdStrike has produced about $1.4 billion in trailing 12 months operating cash flows, and at the same time, it has done about $865 million of stock-based compensation. So well over half of CrowdStrike's operating cash flows are being offset by stock-based compensation, and when you factor in the SBC, its price to free cash flow multiple gets up to around 200, which is just absolutely insane. I understand that this business's revenue is growing tremendously well, and it has been able to compound its revenue by over 30% annually, but at a 200 price to free cash flow factoring in stock-based compensation and 100 times cash flows without that, it's still way too expensive, and I think that the market has gotten over optimistic on this business personally. There's a lot of euphoria and enthusiasm surrounding this name, clearly, and that is baked into the price today. And for those reasons, I'm simply just not interested at all. Now, moving on to Monday.com, this stock saw a massive sell-off after its earnings. It's down 43% over the past couple of months. Its price to free cash flow has dropped down to 28, which is potentially not unreasonable, given how quickly the company has been growing. Its revenues have been compounding by about 41% annually since 2022. If we take a look at its cash flows have also been growing tremendously. They have been decelerating a little bit recently though, but this is another situation where the stock-based compensation is very high at about 50% of operating cash flows. That's way too much for me to be considering a stock personally, and it doesn't really seem like this trend is going to stop anytime soon. In fact, the stock-based compensation is growing at a faster rate than operating cash flows right now. So it's becoming more of an issue, in my opinion, and that is driving me away from the stock. Now, this one, I took a look online to see what people were saying, and it seems like Monday.com, this business model could be the most at risk from artificial intelligence. It seems like it's not too difficult to code whatever this company is offering And honestly, I have not taken a deep dive into what their offering is or how easy it would be to replicate with artificial intelligence. But it seems like this is one of the culprits here where people are very concerned that artificial intelligence could code the business. And that, coupled with a deceleration in their most recent earnings report, did cause the stock to sell off quite a bit. Now, the other stock that I have been asked about a lot is ServiceNow. The ticker symbol is actually now. And this company is in a correction of about 26% from its all-time highs now. And just over the past month, it has fallen by about 16% as well. Just taking a quick look, we can see that its price to sales ratio is around 15, and its price to free cash flow is 46. That is on the higher end, in my opinion. If we do take a look at the company's revenue, though, this thing has been incredible. This is one of the most beautiful revenue growth charts I have ever seen. This thing has compounded its revenues by 41% annually since 2011. However, we can see that its revenue growth rates have been decelerating as the business has grown, which is just kind of the law of large numbers. But as we zoom in, we can see that the company has maintained a compounded annual growth rate to revenue at about 22%, which is very impressive. If we take a look at operating cash flows, we can see that they are at an all-time high of 4.7 billion and have compounded by 30% annually since 2017. This company does have quite a bit of stock-based compensation, not as much as we have seen from the other couple of companies. Stock-based compensation is roughly 30% of overall operating cash flows, so not nearly as much, but still on the higher end. And when you subtract stock-based compensation from the free cash flows, then the multiple expands to roughly 75, and that is way too high in my opinion. Now, even on a pre-stock-based compensation level, this thing is still selling for 46 times cash flows and growing at 20% annually, and I still think that's a pretty high price to pay for this business. So in general, what I have noticed is software companies have come down, but I still think that their price multiples are very high. And this is kind of just a symptom of the US markets lately. I have been saying a lot on my channel that the US markets as a whole are getting on the very expensive end, and I do think that the software companies are part of that bucket. And in general, I think that they're not looking very cheap today. Now, with that being said, let's move on to Constellation Software, because this is one of the stocks that I own in my portfolio that has also been getting hit. We can see that Constellation Software is now in roughly an 18% correction and has been selling off with the overall software space. This, in my opinion, is one of the most high quality companies I have ever seen in the market. The management team of Constellation Software, I would say, is on par with Warren Buffett or very close. It is one of the best management teams that I have ever seen, and that is why Constellation is in my portfolio. This is a truly phenomenal business. And after the sell-off plus Constellation's most recent earnings report, it's actually selling for a price to free cash flow of about 27, but the new numbers are not in stock on unlock yet. So Constellation has seen some multiple compression. It's not quite at the period yet where I would consider adding to my position. I would like to see it get to around $4,000 per share, because at that point, it would be trading for about 25 times free cash flows, which is my price target for this one. At 25x, that is where I start to buy more Constellation Software. Now, why I bring this up is because a lot of people are saying that Constellation's business is one of these software companies that could be disrupted by artificial intelligence. And whenever I think about software and artificial intelligence, I like to go and see what the CEO of Constellation is saying, because he is such a straight shooter. I have full confidence that if there were any disruptions coming to software companies, Mark Leonard would tell his shareholders. He would not sugarcoat it, and he would say, yeah, this is actually starting to affect our business in a meaningful way, and we're materially being impacted. So I go to him for pretty much all of my software news and whenever I need to think about what's going on in software, and I highly respect and trust his opinions because, again, he's not going to sugarcoat it. He will tell me as a shareholder if I am being disrupted in my position. So let's take a look at what he said at the recent 2025 shareholder meeting for Constellation Software. And here's the transcript. And he said, I believe in many instances, we are the trusted IT partner of our customers and are the most logical source of AI knowledge and learning. And although it isn't ready for prime time and you can only get 90% solutions, I think a lot of clients are willing to work with 90% solutions just to get the experience. And I think we're the most obvious source of those 90% AI solutions for clients. So what Mark Leonard is saying here is that currently AI is able to code about 90% software solutions. But what he's also saying is the customers of Constellation Software are coming to them to get these solutions. They're not trying to code this on their own. So what they've seen so far is their customers are not wanting to code their own software because they're not software companies. The software isn't their area of expertise. So what they're doing is they're going to their software provider and saying, hey, we want some of these artificial intelligence features. We want to see what AI can do. Can you do it for us? That's what he has been seeing so far in his business. Then he continues on here and says, we have hundreds of people using AI internally, in development because you've got a constrained rule set, in support because we have knowledge bases. We're worried about it, we're paranoid about it, but it's just I haven't seen it having a dramatic effect yet. One of our expert directors studied this the whole day. We're experimenting across different business units. Some businesses will miss the boat, and that's okay. Then we will simply move capital elsewhere. If anyone figures out a good use, we'll share it across our 700 different companies. So what the CEO said is that he is worried about artificial intelligence and he is paranoid about it, but he hasn't seen it have a dramatic effect on Constellation's business yet. And I do think that this is interesting because Constellation has hundreds of business units now. They're deeply integrated in the vertical software space, but they haven't seen, at least not yet, that they are being disrupted and that customers are churning at a higher rate or they're developing their own software or competitors are coming in and trying to undercut them. And then another director of Constellation says, if someone in our organization figures out how to use artificial intelligence well, then they share that lesson with their entire portfolio of companies. And that is the benefit of their business. So since they have so many different business units, they have so many different engineers, they can share these lessons across the entire organization, and they have hundreds of people working with AI. So they haven't seen disruption yet. They're working with AI, and if they see any lessons, they're going to spread it across the entire organization. So here are some of the key takeaways from the shareholder meeting. They don't think that AI kills their moat. It shrinks development timelines, but customers' trust, domain depth, and workflow integration still matters more. And they do not expect AI to nuke high-touch or deeply integrated systems, especially the kinds that Constellation specializes in. Now, what the CEO also said in this meeting is that if you have a wide platform, a wide software that you can buy over the internet, then he thinks that those types of softwares are going to be easily disrupted by AI because there's not a high touch. You're not working with a sales team, you're not working with a services team to improve your integration or build you more features. If you can simply go and buy a software off of the internet and that's all there is to it, you don't need to deal with a sales team and you don't need to integrate it into your systems that much, then those are the types of companies that are going to be easily disrupted by AI and vibe coders who are going to try and replicate your product. But when you have a deeply integrated vertical market software system where you need to work with your customer, integrate their data and whatnot, then Mark Leonard was saying that these types of customers and softwares are going to be much more sticky. Now, in addition to that, I don't think that people are properly understanding how much emphasis customers place on trust and reliability. I mean, especially when it comes to a company like Constellation Software, they provide mission critical software for their customers. Like their customers' businesses literally rely on the software that Constellation provides. So I don't think that these companies are wanting to go and mess around with what is working and what is being reliable. I don't think that they're going to want to try and code their own software solution and try to implement it when their business relies on what they're already paying for, and it's not a high price. Additionally, I don't think that there's going to be a large customer churn if some new company starts up and then they try to come into the new vertical and try and take their customers. Because why would these companies switch from a mission critical software that they have been using for a very long time? It works well. They like the people that they work with. So why would they try and swap to maybe save 20%? I don't think that when it comes to B2B VMS software, it boils down to price. I do not think that these types of companies compete on price and there is more to it than undercutting each other. So I do not necessarily think that there is a risk yet to a business like Constellation Software. And I do agree with Mark Leonard where he said the software type companies that are potentially at disruption are the ones that are very wide. They don't work with the customers very much and you can easily swap or switch. You can buy them off the internet. So those are the type of software companies that I think are more at risk of disruption. And one last point here, I'll actually just bring over my notes, because I own a business called VTech. I actually shared it on my channel, and funny story, after I shared it on my channel, the stock dropped 17% the next day after it reported earnings. I'm not going to discuss what happened there, that's not the time for this, but VTech's business is very similar to Constellation Software. And here's what VTech's CEO said in regards to what he's seeing. So he said, each niche market imposes stringent demands on specialization. The establishment of a new player requires major investments and frequently involves protracted lead times in product development. At the same time, the markets are relatively small and involve considerable yield costs for customers, which diminishes opportunities for new players to generate returns on their investments. Each niche market usually contains 2 to 4 companies that specialize in industry-specific applications. Generic software generally provides less cost-efficient solutions to unique requirements of vertical markets. VTech always strives to achieve a leading position within its vertical markets. So what he's saying here is specifically with VMS, vertical market software. It's usually very niche markets where there's not a lot of players and the markets just aren't that large. So I don't think that with this type of software specifically, an engineer who wants to try and vibe code a new software solution, I just don't think that there's a large opportunity for them to make even tens of millions of dollars because the verticals don't have that much opportunity. So I think that I've made my point clear. Basically, what it comes down to is I'm not totally optimistic yet that simply being able to code a solution in-house is going to displace a lot of these companies. I also do not think that a new competitor trying to code a product that replicates what a company like Constellation Software is offering is necessarily going to displace the existing incumbent because there's more to it than making a replica and selling it for cheaper. There's services involved. There's high touch points involved. There's these customers simply not wanting to churn. This is mission critical software that they rely on, and they're probably going to be reluctant to try out something new when it could potentially disrupt their entire business. So I am on the fence of not quite being there. Obviously, I'm biased because I own Constellation, I own VTech, I own Topicus. So we're just going to have to see. But so far, these CEOs have said they're not seeing disruption. They are worried about it. They're monitoring artificial intelligence, but right now, nothing has really happened materially to their businesses. So that's kind of my thoughts on the sector-wide software sell-off. I think some companies are at risk, but I don't think all of them are. But I also think that this does provide opportunity, because when you get a sector-wide sell-off that brings everything down, but not everything's fundamentals are actually affected, then you can get the fundamentally sound businesses at cheaper multiples and cheaper prices, and therefore lower risk and higher future return opportunities. That's what I'm focusing on. I have not purchased any more Constellation software yet. I am waiting for it to come down a little bit more. Hopefully it does. And if it does, I am going to be buying some more Constellation software. And I wanted to just update you guys with my thoughts on the software sell-off. And with that being said, that is going to wrap up the video for today. If you did enjoy this video or you found it helpful in some way, then please remember to leave a like on it. And if you're new here and you want to stick around and see more content like this, then please consider subscribing to my channel. Lastly, thank you all so much for tuning in. As always, I truly do appreciate it, and I really hope to see you again in my next video.